There are two important things that Barclays Bank can tell us about making money in the 21st century. One is bad and the other is good, particularly if you're interested in taking part in our £5 a day savings campaign to take out a pension or ISA. First, if you want to make some serious lolly, the lesson from Barclays is one of your best career options remains banking. That is, if you can keep your job and climb the greasy pole. Barclays has plans to pay £2.5 billion in bonuses to its staff. That's an average of more than £15,000 per employee. Not bad for a sector making thousands of people redundant. The bank won't say what bonus its chief executive Bob Diamond will get until it publishes its annual report in March. But even if it's halved, Diamond could still gain more than the £1 million RBS boss Stephen Hester had to give up recently. There is something more useful coming out of Barclays, however. Ironically, it comes from Barclays Capital, the casino investment bank that Diamond used to run. Every year, Barclays Capital publishes its equity gilt study. Equity is the posh word for shares, and gilt refers to government bonds. Shares and gilts are two examples of different areas of investment known as asset classes. The Barclays Capital Equity Gilt Study is remarkable for having data on shares and gilts going back 111 years. It's what makes it such an authoritative report. The report tells us two fundamental things. Firstly, saving is the only way of protecting your money against inflation. Secondly, reinvesting the income you get from your investments is the best way to enhance your financial return. So, had you been alive in 1899 and bought £100 of shares, they could be worth £11,800 today. However, their real value after inflation would be just £160. Meanwhile, £100 in gilts would have grown to just £57, which after inflation would be worth a measly £1. Although gilts have done appallingly badly over the very long term, they do go through long periods when they beat shares. In the past 10 years, for example, gilts have given a better return than shares. That's why experts often recommend you save into a fund that combines shares, gilts and other types of bonds. That way you increase the chance of growing your money. The second important lesson from the Gilt Equity Study is the power of reinvesting the income you receive from holding investments like shares and gilts. Most shares pay a dividend and gilts pay a fixed level of interest. Barclays shows how if the same investor had used their interest to buy more gilts, their £100 would be worth more than £31,000 today. And if they'd used their dividends to buy more shares, their £100 would have grown to £1.6 million today. But before you off to take Bob Diamond for a drink, bear in mind that that total £1.6 million is only equivalent to over £22,000 after inflation. And that £31,000 from gilts is only worth £427 in real terms too, after inflation has eaten away its spending power. Both of those beat what you would have got from cash in the bank or building society. So the lessons are, if you want to grow your lolly, you need to become a long-term saver and reinvest your income. In the coming weeks, I will say more about the sort of funds you could consider. For more information, please look at the guides on the Lolly website.